Since the 2008 crisis, we've spent more than a decade trying to make the global financial system safer. But what if the biggest risks aren't where we're all looking anymore? The very architecture of finance has changed, and a totally new kind of crisis is brewing, pretty much hidden in plain sight. And hey, don't just take my word for it. The Federal Reserve itself is sounding the alarm. They're telling us that the connections inside the financial world are way more tangled and harder to predict than they were back in 2008. This isn't about just one bad type of loan anymore. It's about a complex web, where one little failure could trigger a massive system-wide collapse. So in this explainer, we're going to pull back the curtain. We'll start with this new hidden architecture of finance. Then we're going to expose two huge new sources of risk, these so-called shadow lenders, and a modern-day version of a 1929-style bank run. After that, we'll look at the ticking clock that could set it all off, we'll model how that cascade could spread across the globe, and finally, we'll ask the big question: are regulators even moving fast enough to stop it? All right, let's start with the big picture, right? We have to understand why this time is fundamentally different. All the lessons we think we learned from the last crisis might actually be pointing us in the wrong direction today. This slide really just lays it out perfectly. In 2008, it was all about the big, regulated banks and subprime mortgages. We get that. But today, the risk has moved into the shadows, to these non-bank financial institutions, or NBFIs. Think of them as firms that act like banks but without all the same rules. And the new problem areas? Private credit and stablecoins. It's a completely new game. So let's tackle that first major pillar of risk. We're talking about a massive, murky, and fast-growing market called private credit. This is really where the story of the next potential crisis begins. Just look at that number. $3.5 trillion. That's how big this market has become. And this isn't some tiny niche corner of finance anymore. It has absolutely ballooned into a massive industry. And it's operating mostly outside the view of the regulators who watch the big banks. So what is this stuff exactly? Well, to put it simply, private credit is when investment funds, not banks, lend money directly to companies. You can almost think of it as a parallel banking system. But the key thing to remember is that it's way less regulated and way more opaque, which makes it much, much harder to see the risks that are building up inside. And right here, you can see the danger in black and white. Companies getting their money from private credit are carrying a lot more debt. On average, their debt is 7 times their earnings. Compare that to 5.8 times for companies with more traditional loans. This just makes them way more fragile, with almost no room for error if the economy takes a downturn. And here is the first huge red flag. This chart shows that a staggering 27%, yeah, more than a quarter of these companies backed by private credit are not earning enough money to even cover their interest payments. They're basically zombie companies, only surviving by taking on even more debt. This is a system that is under some serious, serious stress. Okay, let's shift gears to the second pillar of risk. And this one is powerful because it has this spooky historical echo of the Great Depression. We're talking about a $300 billion market for digital currencies that has all the same weaknesses as the old banking system, from before we created all the safety nets. I mean, the parallel here is pretty chilling. Before 1933, the U.S. had no federal deposit insurance. So when a bank failed, people lost everything. And that, of course, caused panicked runs on all the other banks. Well, today's $300 billion stablecoin market works in the exact same way. It's a massive pool of digital deposits with absolutely zero FDIC insurance. If confidence breaks, there is no one to step in. There is no backstop. And hey, this isn't just theory. We've already had a dress rehearsal. Back in March of 2023, when Silicon Valley Bank failed, the stablecoin USDC, which held a bunch of its reserves there, broke its peg to the dollar. Panic just exploded. The only thing that stopped total catastrophic collapse was an emergency system-wide guarantee from the US government. That was a huge warning shot. And right at the center of this risk is Tether, the biggest stablecoin on the market. And it's basically a black box. Audits are always being delayed. Its reserves include really risky stuff like Bitcoin and billions in secured loans to borrowers they won't even name. And what's worse, almost all of its U.S. Treasury holdings are held by just one company. That level of concentrated risk is just immense. Okay, so we have these two huge, unstable pillars of risk just sitting there. But now we need the trigger, right? The spark that could actually ignite the whole thing. And guess what? That spark has a date. 2026. This is the ticking clock. In the year 2026, a mind-boggling $33 trillion in corporate and commercial debt is set to mature all across the world's advanced economies. This creates a moment of maximum vulnerability, where thousands and thousands of companies all have to find new loans at the exact same time. And here's why that refinancing wall is so incredibly dangerous. It's not just the amount of debt. It's that companies who borrowed money years ago at super cheap interest rates, like 3 or 4%, are suddenly going to be forced to refinance at 7 or 8%. For a lot of them, their interest costs will literally double overnight, pushing them right to the edge of bankruptcy. So let's connect the dots. We've got fragile companies loaded with debt, we've got an uninsured digital banking system, and we have a massive refinancing shock coming right at us. So how could this one spark turn into a global wildfire? Let's walk through the model. This table really shows you how quickly things could spiral. In a mild scenario, corporate earnings fall a little bit, and we see a 5 to 7% default rate. Okay, that's manageable. But in a severe scenario, defaults jump into the double digits, and that triggers a deep recession. The systemic scenario, well, that's a full-blown crisis, with default rates and economic damage that could rival 2008. The whole system is just brittle. And this is how the dominoes fall. It starts when that refinancing wall hits and defaults spike. Those defaults slam the private credit funds, which start posting billions in losses. But, and this is the most important part, who invested in those funds in the first place? Pension funds and insurance companies. All of a sudden, the retirement savings and insurance policies of millions of regular people are at risk, as these losses cascade through the entire system. So this brings us to the final, critical part of our story. We can see this crisis building. The question is, do regulators see it too? And are their solutions powerful enough, and more importantly, fast enough to make a difference? Washington has actually acted. They passed something called the Genius Act to create federal rules for stablecoins, requiring them to have full reserve backing and be more transparent. And that's a good step, for sure. But there is a huge catch. The law doesn't fully kick in until late 2026, right when the refinancing crisis is set to hit. And even with this new law, you have to understand, the basic vulnerability is still there. Just look at the comparison. If you have money in a bank, you have a whole system of protections: FDIC insurance, a central bank backstop, government oversight. But if you hold a stablecoin, even under the new law, all you really have is a promise from the company that issued it. No insurance, no backstop, no safety. So, in the end, it all comes down to a race against time. The financial system is staring down a massive, predictable shock in 2026. The regulatory cure is also coming, but it might just arrive moments too late. And that leaves us with one single, crucial question. Can the cure arrive before the crisis does?